Okay, so far we know that we are going to have a portfolio pointed towards small cap and value cap companies, and we're going to do that because we can expose ourselves to higher expected returns over time. We also know that we are going to be following a passive style of investing because that lower level of trading and lower level of costs and the no forecasting dynamic as well is going to keep us tuned into a portfolio that has the potential to do far better than an active portfolio. We've also got to grips with the expected returns from looking back over any decade in the last 3 and 5 decades. And in some cases, we can even go back in our matrix book and we can see the returns over any period of time. We have all of that information there. What we also need to do is, rather than go down the road of exposing ourselves to all of the risks associated with those high cost tax avoidance strategies and tax planning strategies which are pushed to us quite often by trustworthy professionals, rather than going down that road, we need to keep a very simple approach to how we make the portfolio, your investment portfolio, as tax efficient as possible. And the way we do that is to go back to our bucket and look at all of the capital inside it. Now, this is the readily realisable pot that we touched on earlier in the clarity and lifestyle planning sessions. The bucket has our available cash, but it also has our pensions and any other locked away capital. We'll call that P for pensions. We might have some money in our business, and we touched on this all earlier, and we have value within these particular assets. Now, how do we make it all as tax efficient as possible? Well, quite simply, all we will do is every year for any capital outside of your pension, which is a tax-free shell, which grows tax-free and from which you can achieve tax-free cash when you retire, as well as an income, what we also use is an ISA wrapper. Now, ISAs can often be misunderstood. People can get confused between, should I do a bank ISA, should I do an investing ISA, should I do a stock ISA? Look, and people talk about what rates of return they can expect from an ISA. They talk about the ISA as if it, delivers its own return. And here's the thing, an ISA is not an investment per se. You have to not think of it in that way. The ISA is basically just an empty glass. It's an empty box. It's a shell into which you put something. Now, clearly, if you go to the bank will give you a cash ISA. And the bank ISAs will typically pay 0.5% or maybe not even that. Very, very, very low rates of return. So whilst it might be tax-free, you could argue, what's the point in having it? Because it's not going to actually return anything. And you'd be right to think that. So what we've got to come back to and tune into is our investing strategy. Whereabouts are we investing? We're investing into global equities in the developed world and the emerging world, and we're doing it in all markets. That's growth companies, that's large companies, that's value companies, and that's small cap companies. Well, what we would do is any money outside of the pension, we would use the ISA allowance. So say, for example, you had £250,000 in your pension and another £250,000 in ISAs and another £250,000 in cash or other savings, shall we say. All we would do each year is use your available £20,000 annual allowance. And we all have one, so that's us, that's our partners. So every year we can effectively utilise £40,000 per annum, and we can create this tax-free shell around any money that's not in our pension. The pension, of course, is going free of income tax and capital gains tax too. So we make your whole portfolio super efficient by just using simple allowances. Now, if you've used your £40,000 joint ISA allowance for the year and you've funded your pension to the maximum as well, and we're all restricted on what we can put into pensions nowadays as well, following the reduction in lifetime allowance and indeed the annual allowance, which is capped at £40,000 now. But clearly we have to be paying tax to get the relief on that amount. But what we can do outside of that is also use an investment bond structure. Now the investment bond would allow you to put more capital in to your portfolio. It's all in the same place, it's all invested in exactly the same area, but the investment bond would also act as a good tax efficient shelter, because ultimately you can take 5% a year from that and pay no tax on it. And that's because over 20 years it's classed as a return of capital. So through a pension, an investment bond, and just using the ISA allowance, that's how we maximise the tax efficiency within your plan. And we will do that automatically with you on a rolling basis, on an annual basis. So no silly tax schemes, no silly tax avoidance plans, just simple, straightforward, vanilla tax planning, which gets missed. And recently reports have suggested that up to £360 billion a year is missed by everyday people in the UK who just fail to use their annual allowances. Well, our clients don't, and we'll make sure you don't too.